Hello and welcome to Chapter 15 lecture video here. If you're following along with your course pack, we're on page 310. So in this lecture video, I'm going to be talking about the basics of investments. I'm going to be talking about why companies make investments. I'm also going to talk about cash equivalents, short-term investments versus long-term investments. I'm going to talk about debt versus equity securities, and then also do some basic journal entries in terms of recording securities, okay? So when we talk about why companies make investments in other companies, and so that's what we're basically talking about here. One company making an investment in another company. Well, company A may have some excess cash, and so rather than just leaving it in the bank account, what they might want to do is to make a key investment in an important supplier. So what they may do is buy the stock of that supplier to exercise some ownership control, or they may buy the debt of that supplier to help maybe that supplier finance or expand operations, okay? When we talk about cash equivalents and short-term investments versus long-term investments, okay? So that's one classification that we have. Short-term investments versus long-term investments. Talk about cash equivalents, investments that can be easily converted to cash and that mature within 3 months. But we also have short-term investments. Those mature between 3 to 12 months. And there's securities such as debt or equity securities that management intends to convert to cash within 1 year or the operating cycle, whichever is longer. They are reported in the current assets section of the balance sheet. On the other hand, when we talk about long-term investments, we're talking about investments that are not easily convertible to cash in the short term, and they are reported in the non-current section of the balance sheet under long-term investments. Let's also talk about debt versus equity securities. So debt securities reflect a creditor relationship. So when we're talking about a debt security, what we're really also talking about is purchasing the bonds, maybe, of a key supplier. Okay. Purchasing the debt of a key supplier, going back to that example that I was talking about investments in a key supplier. When we talk about equity investments, what we'll be talking about there is purchasing the equity or the stock of a key supplier. And that would reflect more of an owner relationship. Okay? When we talk about classification and reporting for these securities, it depends upon whether it's debt or equity. As I was saying earlier, whether it depends upon the management's intent to hold the security for short term, year of the operating cycle, or longer term, longer than that, because that dictates where it's reported. The current assets section or the non-current section of the balance sheet would be the long term. And then finally, it also depends on the companies. We're assuming that the company is the investor there. This company is investing in a key supplier, for example, that type of relationship here. Depends upon their percent ownership in that key supplier, and that revolves only or relates only to equity securities, because equity securities reflect the ownership. Debt securities are a creditor relationship. So continuing on over here, we do have some basic accounting for our debt securities. And before we even want to talk about that, you can see over here on this is on page 312, so I'm zooming in a little bit right over here. We do have a nice little table that that shows you how these different securities, based on their classification, would be reported. So if there's trading, we have our debt and non-influential equity securities that are actively retraded. We report those at fair value, and we'll talk more about that. If we have debt securities that are intended to be held to maturity, those would be reported our amortized costs, and we'll do an example of that here. Available for sale or equity and non-influential securities are reported at fair value. Significant influence, this is only revolves to equity securities. That means we have a big ownership in the company. That would be our equity method. And then controlling influence is even more equity securities with controlling influence. That would be under the idea of consolidation. And we'll talk about these in future lecture videos. But what I want to talk about now, and I'm going to zoom this camera back up a little bit, is just some basic journal entries for dealing with debt securities, okay? So debt securities are reported at cost when we purchase them. And that's because of the cost principle. Remember the cost principle we talked about back in Accounting 101? We're saying that we report anything that we buy at cost because that's the most objective. Okay? So the same applies for purchasing debt securities. And so in this example, what we're going to be looking at is that we have a company that is going to be buying the bonds of another company. Okay? So when they purchase those bonds, what price do they show them at on the balance sheet? Okay? They're going to show them at the cost. So when we look over here on our September 1st, Music City paid $29,500 plus $500 brokerage fee to buy Dell's 7% 2-year bonds payable with a $30,000 par value. So Music City is buying Dell's bonds. Okay, Music City most likely has some excess cash, and they want to use that to maybe buy bonds in this other company. Maybe it's because they're a key supplier. We're not given enough information, but that would be one example. The bonds pay interest semi-annually on August 31st and February 28th. Music City plans to hold the bonds until they mature. Record this transaction. So for Music City, and we're recording this for Music City, this transaction we're recording for Music City. For Music City, purchasing Dell's bonds, that is going to be an asset. Okay, so for Dell, it's a bonds payable. That's a liability. But for Music City, we're buying these bonds, and so this becomes an asset for us. Okay, this HTM means held to maturity. So that's why it's saying right over here, until they mature, that means the HTM held to maturity. Okay, so basically, if we think about this again, Music City is buying these bonds. What are they going to buy? What are they going to buy them with? Cash, right? So we know right off the bat that we're going to have to pay cash to buy these bonds from Dell. That means cash is going down. So we know right off the bat that we're going to have to credit cash. But we're also buying an investment. We're treating this as an investment in Dell. So this is becoming an asset for us, right? So when we think about this in terms of our journal entry, our date, 9/1, we will debit long-term investments, HTM, held to maturity, and I put Dell, which is the company's name right there, in parentheses. I ran out of room, so I put this on the second line. That's $30,000, and that's a debit. Debit to long-term investments, because this is an asset for us. How do we increase an asset? With a debit. And then what do we credit? We credit cash for $30,000, because that's how much we had to pay. Now if we look over here, if we think about what is going into the cost basis, $29,000 plus that $500 brokerage fee. So what goes into the cost basis here is not just how much we paid, but also the brokerage fee, because that'd be a normal and reasonable expense. Okay? So continuing on to the next page, we're going to talk about recording interest earned right over here. So when we purchase this debt, the bonds of another company, in this example, we're Music City, we're purchasing Dell's bonds. What we also get, right, is we get interest revenue. If you think back to what we talked about in some of the in chapter 14 with bonds payable, Dell is issuing bonds. So that means they are going to eventually have to pay back the par value, but they're also going to have to make periodic interest payments in this period. Those interest payments could be semi-annual, they could be quarterly, or they could also be on an annual basis. Okay, but they are going to have to make those interest payments. For that company, for Dell, that's interest expense. But for us, we are going to receive the interest. So this becomes interest revenue. And we're going to receive that eventually in cash. Now, if we look over here, it says, referring to the example on the prior page, record the interest earned for December 31st. So remember, they were issued on 9/1. Okay? That's on the prior page. It said they're issued or we purchased them on 9/1. And if we think back to the way that we talked about in Chapter 14 about how to record how much interest expense we pay our bondholders, how much interest we pay our bondholders, it's always par value times the contract rate. So if you looked on the prior page, it said the par value was our $30,000. Our contract rate was 7%. Now, what I also have to do is that this is going to be semi-annual, right? But look, I have to redo my year-end accrual to accrue interest revenue earned. So we're not going to be paid yet for this interest revenue until February of the next year. But on December 31st, I have to record that we have earned 4 months worth of interest revenue. And how do I get 4 months? September, October, November, and December. So the way we calculate how much interest that we will receive is the same way that we calculated how much interest the bondholders paid as we did in Chapter 14, which is par value times the contract rate. In this case, though, it's only for 4 months. So I multiply this times 4/12, which gives me $700. So what I will do is on 12/31, I'll do my entry to accrue 4 months worth of interest revenue. Now I can't debit cash because I haven't received this in cash yet. So what can I debit? I can debit my interest receivable for my $700, and then I will credit my interest revenue for $700. Okay? Now, in the next accounting period, the next year, Music City will actually receive the interest revenue in terms of cash. Now, how much cash do they get? Remember, we take our par value times our contract rate times, in this case, remember, this contract rate is on a yearly basis. So they're going to get half of that right now because it's on a semi-annual basis. They're getting paid semi-annual. The contract rate, as we talked about back in Chapter 14, is stated on an annual basis. So if you multiply only 30,000 times 0.07, that would be for the full year. But now they're getting paid after 6 months because it's semi-annual interest payments. That gives us our $1,050. So we can come over here. It's on 2/28. You can debit cash. Now, I earned $700 worth of that interest revenue in the prior accounting period, which means I only earn in this accounting period $350 worth of interest revenue. How did I get that? The $1,050 minus the $700 right over here. And then we are also going to be paid for this interest receivable because we set that up at the end of the last accounting period, and now we're being paid for that. So our interest receivable goes down, and the way that I recognize that an asset is going down is with a credit. So this becomes my journal entry right over here. In the next lecture video, we'll continue on with additional journal entries for debt securities and dividends earned and also more equity securities. Thank you so much.